X Limited has equity shareholder funds of 50 million. It has approached the bank for working capital facility. The bank analyzed the balance sheet of X Limited and said it's a weak company. The managing director of X Limited turned violent and asked the banker, "Why do you say our company is a weaker company? We have 50 million invested by shareholders, and why do you say so?" So here you have the balance sheet of X Limited. Can you say why banker passed such a comment? So let's analyze. The equity is 50 million and there is a debt of 450 million, so their total liabilities is 500 million. And if you look at their current assets, it's 100 million, long-term assets 400, it's 500. Okay, but what is the problem here is this company is sizably dependent on debt funds, because if you look at the composition, I would say the 90% of funds for this company, 90% of the funds have come only from debt. So what's the problem there? See, this debt will do wonders when things are going well. I mean, this is called leveraging. We call this as leverage effect. This will do wonders when market is doing well, and it would ensure that business collapses when the market is not going to do well. Let's understand that. Let me give you a small example. So here you got a debt of how much? 450 and equity of 50 and the assets of 400 and 100. Let's say this particular business model would ensure the return on investment. Let's say it would ensure the return on investment something like 10 percentage. Okay, this is the return what you are going to get. So what's the total investment in this business? The total investment, we know it is 500. Okay, so the return on investment is going to be 10%. So if I calculate the return, and that return is nothing but EBIT, it's going to be 500 into 10%, you're going to get 50. Okay, now this 50 got to be shared between two group. One is debt, the other one is equity. Okay, so here you have debt. How much? What's the proportion of debt? 90%. And let's say these guys are going to expect somewhat like 8%. On 450 you have to pay them 8%. Okay, less interest at 8%. It means on 450 you have to pay 8%. 450 into 8%, you got to pay 36. So this is the return which is available for shareholders. And it is again not directly available for shareholders. You got to pay taxes. So 50 minus 36 is the return available for shareholders. Let's say you have to pay taxes, less tax, somewhere like 30 percentage. So on 14 you pay 30%. So 14 into 30%, you got to pay 4.2. So I would say net return for shareholders, this is nothing but my profit after tax, and that is 14 minus 4.2, 9.8. So now let's try to measure what is the return available for equity shareholders. So what is the amount invested by equity shareholder here? They have invested 50. Fine. So equity is 50. So now if I calculate what is the return for equity shareholders, that is return on equity, that's nothing but net return for shareholders 9.8 divided by their investment of 50. It means they are getting a return of something like 19.6%. Fine. Equity shareholders should be happy. Here equity shareholders will be happy, but not the banker, because the banker, they always try to have very conservative future. I mean, they will not expect that future will always give you sweetest things. They expect that future will always carry something bitter also. Here, what was our understanding? The return on investment is 10%. So what the banker will look at is what will happen if this return becomes 8%. What will happen if this return becomes 5%? Let's see how it goes. Let's say this return is going to become 5% instead of 10%. It means on 500 you are going to get only 5% return, right? That is, on 500, 5% you are going to get return of only 25. But what's the loan amount? We know the loan amount is 450, on which even 8% on 450, even 8% interest is going to be 36. It means shareholders are not going to get anything, but more than that, even the bankers are not going to get what they are entitled to. They are entitled to 36, but what they can get is only 25. So 25 minus 36, they already facing shortage. So who should give this? Equity shareholders. And it is not possible for equity shareholders to give all the time. Of course, when you have laws, you don't have tax, but the return for shareholders is only this loss. And what is the amount they have invested? They have invested 50. So whether they are getting any return here, no. But in turn, the capital which they have introduced is 50. Now that would come down by 11. That is, their capital will stand revised at 39. They lost 11 in the business. So I hope you are getting the message. The bankers will not be impressed by this high level of debt figure, because for a small change, that is from 10 to 5, okay, from 10 to 5, or if I change it as 7%, let's see what happens. Even then the bank is going to be at risk, because the profits are 35, what they got to pay is 36, the loss is 1. You may say that loss is only mere 1, but please don't forget, principal, loan principal also got to be repaid. I have never factored the principal here, right? So bankers are not going to be impressed by this big number. It may do some wonders for equity shareholders in scenarios like this. Let's say instead of 10%, if the return from business is 15%, then the return available for equity shareholder will become 54.6%. But if the same number becomes 5%, equity shareholders are going to become losers. They are going to lose your money. Okay, so the debt will do wonders. It will also create disasters, and that have to be taken into consideration. And that's why here the bank said you are a weaker company. You are a weaker company because you are too much dependent on debt. And it means if the bankers are going to withdraw the support, your business is at a huge risk. Or if the return on investment is going to undertake is, or if it is going to undergo a minor change, then again you are in a serious trouble. Okay, that's why the bankers have passed a comment that it's a weaker company.
Thanks for watching this video, and I hope you like this lecture. If you wish to learn more on the areas related to this topic, check our comprehensive course. I have shared the details and link in the description below. Click sign up and enroll. I'll see you inside the course.